Welcome back to the Business Leaders of America podcast, where business leaders come to share their advice and journeys to success with existing and emerging leaders of America. Now, here's your host, Dylan Bloyd.
Hello, everyone, and welcome back to the Business Leaders of America podcast. Today, I'm joined by Dr. Adam Link, founder of Fireweed Capital and a unique voice at the intersection of technology, investing, and real-world financial strategy. Dr. Link has managed over $600 million for more than 2,500 clients, but what sets him apart is not just performance, it's perspective. With a doctorate in computer science and experience leading cloud optimization at Coinbase, he brings a data-driven, system-based approach to investing that challenged many of the traditional assumptions in wealth management. In this episode, we'll talk about the hidden risks of passive investing, why most diversified portfolios fail when it matters most, and how founders and high earners can build strategies that go beyond average advice to truly protect and grow what they've built. Dr. Link, welcome to the show.
That's great to be here. Thanks for having me.
Yes, absolutely. So, you started your career, Dr. Link, in financial advising fresh out of college, right? So what initially drew you into financial advising, and what stood out to you about the industry early that made you want to, pursue a career?
Yeah, so I've actually kind of got a bit of an interesting story when it comes to finance and tech and kind of the interplay of both of those throughout my career timeline. So yeah, I did go into financial advising out of college, and really, I I got my major in finance, specifically with a focus on capital markets finance. And where I went to school, there were basically two tracks for finance. One was capital markets, and was corporate finance. And I didn't really want to spend my entire life doing net present value calculations to determine what a company should invest in, right? For me, I actually was one of those weird people that loved doing math in a finance degree. And when we got to like Black-Scholes options pricing models, for those of you who don't know what that is, like you're verging onto like calculus type of stuff. At that point, it's fun, right? I thought that was incredibly fun. And I really just loved the capital markets and the fact that every day you wake up and it would be different. So I ended up, going into financial advising out of college. And really, it was not the right time in my career for me to be a financial advisor out of college. I realized that, I was sitting there with textbook knowledge, but no experience, and ended up actually leaving financial advising to go into tech for about a decade or so. And really over that decade ended up kind of what I like to call, learning and earning my place on this side of the table as a financial advisor. And basically now when I talk to folks, it's like, well, I've got all these stories of, well, my friend did this, or I did this, or back in this day. And now being an advisor comes much more naturally, right? Because I can draw on a wealth of real world experience of things that I've done, things my friends have done, things I've seen work and not work. It just allows me to be a much richer financial advisor for my clients, right? Because I've got stories I can relate.
Right. Yeah, there's only so much that the school can teach you, right? And so real world advice and real world experience is going to take you so much further and be able to, relate back to those situations that you've been through to really build those relationships with those clients, right?
Exactly. Yeah, and it's not to say, I've got friends who've been very successful financial advisors directly out of college.
Yeah.
Right. And they kind of follow the script they're given. And then, over time, they too get stories. But it's not to say that you can't be a good, successful financial advisor when you're younger. I've just found for me, I felt like I wasn't advising from experience. Right. And I was like, no, I got to go get experience first. So I went and did that. Took a detour for a decade.
Yeah, exactly. Yeah, when I was doing my research, I saw that you even mentioned that you felt like imposter syndrome, right, when you were advising clients. So what do you believe that then that you strongly disagree with now, that, don't have that imposter syndrome?
Yeah. So I actually remember one client meeting, and this is like really where I started realizing I was kind of out of my depth as a new graduate advisor. An individual had come in and they had about $150,000 or so saved up for retirement.
Yeah.
Which, quite frankly, given where they were in their life stage, was not nearly enough for the retirement that they wanted.
Right.
But at that point in time, I had student loan debt, I had credit card debt, I had, I was barely scraping by to pay rent. And so I'm sitting there, in a suit across the table from this couple as they're explaining their six-figure net worth. And I was just thinking, man, you guys are so much richer than I am. Like, I can't possibly tell you what to do with your money, right? Like, it just felt weird. And listening to a more senior advisor be like, well, you don't have enough. I'm sitting here, I'm thinking, well, they don't have enough. Man, I really don't have enough, right?
Yeah.
And so that was kind of one of the key turning points for me where I said, look, I'm not ready to be a financial advisor as a, younger 20-year-old. Now when I look at kind of what I've learned in a long time, in the many, many years I've been in the industry, and in my career, I think I started out with this idea that there was one investing strategy for everyone, right?
Mm,
And that investing was fairly obvious. And what I've really learned since then is that I think, at least, the passive investing strategy that a lot of folks are taught initially, and that's taught in a lot of financial advising courses, is actually incorrect. And investing is not nearly as simple as I had initially thought it was
mm.
coming out of college.
Got it. Yeah, no, I totally agree with you. And exactly to our point earlier, like you said, people can definitely have successful careers right out of college, but there's only so much that the textbooks can teach you at that leading up to that point, right? And so that's exactly it. And then at the same point, like you said, is that they only teach certain ways too. So of course there's got to be different ways. There's going to be a million different ways that you can do certain things, to still reach that high. So I'm really looking forward to getting to that point. I did want to ask you before that though, is when you stepped away from advising for a little bit, you spent a decade in tech, before coming back, right? So
Mhm.
what did Silicon Valley teach you about wealth building and that traditional finance completely misses?
Oh, that's a great question. I think you meet more millionaires in Silicon Valley than you do in normal life,
Yeah.
right? I think back to the stories I have about my friends in Silicon Valley, my friends on the West Coast, East Coast, and many of them are multimillionaires,
Mm,
and you just have different stories when you're talking with people who are in a higher net worth, right? I've got stories of, my friend has an Aston Martin, right? And like, how many people, first of all, even know what an Aston Martin is? It's a very expensive $250,000 sports car.
yeah.
And I remember, he took me for a ride in that thing around the streets of LA. And that's an amazing car, right? It's
Yeah.
so cool. And I get firsthand why people buy sports cars,
Yes.
right? And so when you look at that, you're like, what did that teach me about building wealth that textbooks don't teach you? Well, a textbook will never teach you what it feels like to be doing 70 down the highway in an Aston Martin,
Mm,
right?
yeah.
And just the way that that individual thinks about money, the way that he lives his life was just wildly different than what I had experienced growing up in the Midwest and what I had experienced, from textbooks, right? Where textbooks throw around values like 1 million, 2 million, 10 million, right? It's like, yeah, there's always an M after every number in college because you need a big enough number to make the, exams interesting.
Hmm.
When you actually meet millionaires, right? Some of them are like that guy with the Aston Martin. Others of them, you would never know how wealthy they are because they just are very, very low profile. They've got, one or two toys, and that's it.
Wow.
They're just the most down to earth people, right? And I'm
Yeah.
thinking of a particular friend who's worth probably north of $400 million,
Hmm.
right? And you're just stuff like that, right? Like you would never suspect. And I think really what that taught me about wealth is that as people are growing their wealth, you don't always have to spend everything you make. And at a certain point, you don't necessarily think about earning more money as the sole goal.
Mm,
And it's really cliche because a lot of people will tell you this that, like,
yeah.
look, at a certain point in time, making money isn't the only thing that matters. You got to do it for something else.
Hmm.
And I really do think that the more you get into Silicon Valley and you do talk to the wealthy founders and wealthy entrepreneurs and wealthy venture capitalists, they're always doing it for something more than just the money, right? Like after that first million, you're like, cool, I'm a millionaire. Check the box, right?
Yeah.
And then it's like, okay, now what do I actually want to do with my life? You got enough money that you don't have to work. You got enough money that you can do something. Like, what do you actually want to do? And that's, at least to me, the fun part of being in Silicon Valley is you meet all these dreamers who are suddenly rich enough to follow their dreams. And, that's where you just get to, I don't know, it's esoteric fun, right?
Yes.
People do different stuff with their money.
Right, right. Yeah, exactly. Yeah, and I think that a lot of, with people who haven't gotten to that point, they're like, man, money will solve all of my problems, right? But once you get to that point, there's only so many trips you can take. There's only so many toys you can buy. Of course, if you're living well, not within your means, you're going to run out of that money pretty quickly. But like you said, you have to have some meaning behind your life, right? And that's like the number one thing. It seems like a lot of people talk about. I had a guest a long time ago who had opened up he was something in security, and he hit his millionaire status because he was like, "That's what I need to hit. I need to hit that millionaire status," and he did. And then after that, he's like, "Man, what do I do now? I'm still under 30, and I have my whole life ahead of me. I'm not just going to sit here and not do anything." So he started a cookie company. He's been super successful, but to your point, exactly, like you have to have something, after the fact, right?
Yeah, there is, just speaking from my own experience here.
Yeah.
When I was in college, right, I used to watch my money incredibly tightly. Like,
Hmm.
could I afford an $8 cheeseburger? Sorry, an $8 hamburger or a $9 cheeseburger? Right, like it's extra dollar for cheese, right? And some days you have $9, and some days you didn't have $9.
Yes.
And I just remember having this like biological like drive to become a millionaire, right? Like it would keep me up at night. It would just be something like, I'd start thinking about it, and like, like your throat would almost close up because you want it so bad,
Yeah.
right? Um, and I remember early on when I was a teenager, someone telling me like, you'll be a millionaire. I can just like, I can see it. Like you'll be a millionaire. You work hard, you're smart, you'll be a millionaire.
Hmm.
And so much of my life was focused on, I got to hit that millionaire status. I got to hit it. And like I said, just like a biological, like primal drive.
Hmm.
And when I hit it, I had that same, that same realization of like, cool, I hit it.
Yeah.
And then you wake up one morning, you're like, okay, I'm a millionaire. Great. What now?
Yeah.
Right. And like the primal drive, like that biological drive to become a millionaire, like drops, right?
Hmm.
It drops off. Like there wasn't any more like this, like, catch in my throat when I thought about becoming a millionaire. It was just like, all right, I'm there.
Yeah.
And now it's like, okay, well, where's that drive, right? What is the next thing that gets me physically engaged like that? And I, I've never really talked about this on a podcast before, but I'd
Yeah.
be interested in knowing like how many other millionaires like had that, where like once you hit it, like you're physiologically like you just change.
Hmm.
And it's like, okay, well now where do I get that drive, right? Um, So yeah, that's, at least for me, I kind of get that now with financial advising. And so like that's why I'm pursuing advising now, because I want to help people, get to that same status that I had.
Hmm.
Um, but yeah, it's so true, man. Like once you hit that $1 million, if that's what you're going for, if you want to be a millionaire, like go for it, get that status. And then once you get there, just be ready to have a midlife crisis,
Yeah.
because it will happen. You will wake
Right.
up the next morning and you'll go, well, now what?
Hmm.
Right? I made it. I'm there. I got two commas. What now?
Yeah. Yeah. It's almost like it's like the thrill of the chase is the exciting part. And then once you hit it, you're like, man, what's going on? And so it's amazing that you've gotten there. And I've spoken with a decent amount of leaders who have very similar stories. And even when they're talking about other people that they've encountered or they've engaged with who have talked about how they don't even take any time in between, ventures, right? Like they'll get this company to such a high level and then they'll exit and then they're right into the next one without even taking any time to like really enjoy it because of the fact that they just enjoy that chase to get to that point, right? And so I think you're spot on with that. And I'm really wondering now also, how many people really do feel that, or if people have finally, if there's maybe it's like like where you're at in life, I guess, as well. Maybe if you're in your 60s, 70s, maybe you're just like, okay, I'm happy with life. I'm just gonna retire and be done. But if you're in your 20s, 30s, 40s, 50s, even, then there's something after.
Hmm. Yeah, and I'd also say kind of, and again, like I said, I haven't really talked about this on a podcast before,
Yeah.
but I've tried getting myself psyched up in the same way about getting to 10 million.
Yeah.
Um, and it's the weirdest thing because like my body doesn't react the same way that it did when I wanted to become a millionaire. And maybe it'll eventually kick in, but like you really do reach this plateau at a certain point of like, I don't need to work. I have all the money. Like it's kind of, I'm set.
Hmm.
So my biggest warning, I guess, for those listening would be, if you're going to be a millionaire, don't set your sights on a million, set it higher, go to five,
Yeah.
right? $1 million, it's great, but it's not $1 million back in 2000, right? It's $1 million now in 2026, and it doesn't spend like a million.
Like you said, being that there's a primal instinct, of trying to get to that, it's almost best to, you know, Grant Cardone it, right? You got to 10x it, 10x your goal. So then you're not disappointed if you hit, you're shooting for that 10 million and you only hit 5 million, you'll be happy. But at the same time, you set it too low and then you hit it right away. Of course, you could set other goals, but it could be to the fact that it be similar to what you experienced, where you're just not feeling that same thrive to get to that point. Of course, it's great. You still have drive every day, but it's just not the same type of drive, right?
Exactly. It's not the drive that keeps you up at night.
Yeah.
The drive that lets you make concessions and sacrifices. So yeah, that's what I'd say. Where we are in 2026, if you want to become a millionaire, stop thinking you want to become a millionaire. Say I want to be worth 5 million. Set your goal there. Set your goal at 5 million, right? Because like it's still hard to get to,
Yeah.
but you'll also be set up well enough when you do hit it that you're not going to end up, I think, completely dissatisfied.
Right, right. No, you're absolutely right. And you've been pretty vulnerable about this stuff. You talk about being, of course, the drive wasn't there, but at the same time, imposter syndrome. You talked about that, but you also talk openly about losing 800K in real estate syndications, right? So you managed over 600 million, but what specifically went wrong, and how did that loss permanently change how you evaluate risk today?
Yes. So losing big money in real estate is not hard to do.
Mm.
Making big money in real estate is hard to do. So real estate is one of those areas that I see a lot of folks want to get into because it's easy money, passive income, right? There's a whole host of speakers out there that will talk about how you can buy houses and get passive income and all this, right?
Hmm.
Um, Real estate's a very, very tricky animal when you actually get into it. So in real estate, the number of people who are incredibly wealthy is very small, and their stories are also not straightforward. I can't say the exact statistics here, but I'll just say kind of anecdotally.
Right.
I've met a number of folks in real estate who are up or down $1 million depending on the year, right? Folks who have gone from 10 million to zero, and now they're coming back at 3 or 4 million, right?
Mm.
So those types of swings are incredibly large, and it takes a very unique personality to go through those swings successfully. Most people, once you reach millionaire status, there's like, again, a fear of ever going below millionaire that, you kind of just, you'll stop. And like successful real estate people, you just double down again. You just
Yeah.
keep going, right? You just keep building. And I think that's what was a bit of a mismatch with my investor profile, first of all, that I tend to not like wipeout risk like that.
Mm.
For a lot of folks in real estate, what you don't realize is on those bigger projects, an individual is basically pledging their entire balance sheet as a key partner against the loan. And so when something goes south, they could be on the hook for $2, $5, $10 million loan.
Yeah.
And for a lot of them, they're probably on the hook for $50 to $100 million in loans by the time you get at scale operating. And all you need is, one of those assets to go south and your balance sheet is wiped out, your liquidity is gone. And even if you have money in other properties, it's not like you can turn around and sell, a $2, $5, or $10 million property easily.
Hmm.
Right? Like, so there's a lot of stuff in real estate that it's, cash flow is a problem, your liquidity is a problem, and there's a lot of ways you can blow up really big, really quick.
Mm.
It's like if you were to go into a stock and then take out 4x leverage against that stock, right? Like
Right.
that's essentially what real estate is, right? If you're going to sit there and buy, 20% loan to value, you have 20% equity, 80% loan to value, right? You're basically 4x leveraged.
Yeah.
And so again, like when you wipe out, you face massive wipeout risk, right?
Hmm.
So what happened for me, there's a whole host of stories there between outright fraud, where I lost some money in outright fraud,
Wow.
to just a deal going south where I was one of the key partners.
Mm.
And it's not hard to lose a lot of money in real estate when your equity goes south, and when you're trying to prop up a deal. And um, I think I did right as best I could by the partners in the deal. We all lost money. Um, but yeah, it was basically just one of those like, yeah, everyone takes a haircut on this
Hmm.
deal. Um, but the funny thing about real estate is no matter how much money you're losing in real estate every month, you still have to pay a mortgage.
Yeah.
And so when you go from making money in real estate every month and it's thin margins to what we ended up happening. What ended up happening to us was we basically misidentified the class of tenants we had in one of our properties, and we got a slightly worse tenant than we thought. Slightly worse class of tenants than we thought. They were a little bit rougher on the property than we thought they would be, and we ended up having high repair bills. And so when you take a fixed amount of rent that is controlled by the market and you add on high repair bills and a mortgage, you quickly find yourself operating in the red. And it doesn't really ever sink in on an academic level when you're operating in the red. But as a small business owner, when you're operating in the red, that money has to come from somewhere.
Yeah.
And that looks like your bank account, your credit cards, a bank line of credit, right? And like, yeah, in real estate, you're supposed to be, protected because you set up an LLC and it's the LLC that goes bankrupt, not you and all that. But in every single loan that you take on from a bank, it's going to be a recourse loan, which means there's a thin little line in there that says if the property doesn't pay it and if the LLC can't pay it, I agree that you bank can come after me personally. And so the reason you set up your LLC is you don't have liability when somebody slips and falls in the property. And that's great. But your biggest risk is that mortgage coming due. And guess what? You're still on the hook.
Yeah.
So that's, in a nutshell, a what went wrong in our real estate venture. There's probably a whole host of other stuff we could dig into, the exact operational failures and all that. But it was a business that didn't work out, and it was a business that didn't work out that was levered, that was doing a lot of money, and we had to sell it. We had to sell it as quickly as we could, to leave with what money we had left.
Right. Yeah. I mean, and mistakes. I mean, it's not even mistakes. It's just situations like this happen, right? And in the finance world, it's going to happen. Nobody can. If everybody could predict the market, then everybody would be these millionaires that we're talking about, billionaires, right? And so I liked what you said early on about those people who are wanting to continue, retain or sustain that millionaire status, right? So I feel like that's also a chase, right? Is making sure that you stay a millionaire rather than just as much as you want to get to that point. But you're absolutely right. I feel like, it's what I like about the whole last part that you talked about is the fact that you're being vulnerable about it, because you, as a financial advisor, it's tough to do, because if you say that, that could immediately make people be like, okay, I'm going to go somewhere else. He lost 800,000, it's like, again, you're also managing over 600 million, right? And so you've learned from your mistakes. Sometimes those mistakes have to happen for you to get to where you are today as well, right?
Yes. So one of the things that I would say about looking at somebody who's lost money in investing before, this is something that venture capitalists and angel investors will tell you all the time, is you want to be very careful the first time you invest with a founder who has no track record. The ideal person that you invest with, and this is what I truly believe as well as a financial advisor, right, is you want to invest with somebody who's taken a couple hits, right? If you can show me an entrepreneur, and I do some angel investing as well, but if you can show me an entrepreneur that has failed and has succeeded, and this is their third time at bat, that's like the ideal person to work with, right? You show me an entrepreneur that has had nothing but home runs 3-4 times in a row, that's an incredibly risky investment, right? Because they've never, at least on paper, right, unless I get to know them better, they've never had a failure. And investing with someone who's never had a failure means either they're lucky or quite frankly, they're a good operator and they've pulled it out, right? But it's highly likely that they are lucky at that point. And you just want to get a sense of like, okay, well, is it just they're lucky in one industry? They're just lucky that the industry's growing? Are they just, right? Like there's all these other factors that could make you successful multiple times in a row without you necessarily knowing why.
Right.
And so similar thing, when you talk to a financial advisor, you talk to somebody who's like, yeah, I've only ever had up years. I've never gone through a down. Okay, well, first of all, you're talking to an advisor who hasn't seen a full market cycle, right? But an advisor that can say, well, yeah, I've had clients who've been down 20% in a year before. It's like, yeah, of course I have, right? Like, there you go. I've seen a full market cycle. I know what to do when the market turns on you, and I've had experience coaching people from the ledge.
Yes.
Right. And if I've lost money as well, like this is now coming from my experience. It's not coming from textbook. It's coming from like literally, I wish I had done this different, or I wish, I did this and it worked. Right. So that's kind of how I look at that. That loss is like much the same way I look at my losses in angel investing and venture capital. Like it made me a better investor. I know what to look for now.
Right. Yeah, exactly. Yeah, absolutely. And, try to stop the bleeding as best as possible, ease the blow, right? To the best of your ability. But things are going to happen, right? And so, speaking of that, you've been vocal about flaws in set and forget investing, right? So, through your work at Fireweed Capital, where do you see passive investing where like it fails most, especially for high earners and business owners?
Yes. So one of the things I see about passive investing is that, and this is what the training courses for financial advisors teach all the time,
Yeah,
what a lot of people are exposed to through like Vanguard funds and stuff like that. So passive investing, the idea is basically you put money into the stock market or a portfolio, and you walk away, and then you come back, and it has grown. Now, on paper, that sounds great, right?
right.
Super simple. You don't do anything. In practice, what happens is you check the market and you check your portfolio and you log in at least once in a 20-year time span, or you contribute money at least once in a 20-year time span, where you do anything with this pot of money in a 20-year time span. And what does that do? That gives you a data point. And that
Mhm.
data point says my portfolio is up or my portfolio is down. And so what you as a human are now doing is assessing risk. And you've now broken the core principle of passive investing, which is do
Mhm.
nothing. So the question then becomes, as a human, if you are unlikely to actually walk away for 20 years, and you're likely to break the core tenet of passive investing, which is you're going to check and do something,
Mhm.
well, then passive investing doesn't work, right? Then we've got to find another investing paradigm for you to use.
Yeah.
And that, at least in my opinion, is active risk management, where you take an opinion on the market and you do something about it. And you might not always be right, but you're doing something. And when you look at human psychology, there's actually academic studies that back this up, that the average investor gets below the market return by about 1% to 2% every year.
Mhm.
And the reason for that is humans are hardwired to do something. We all believe we can control more than we can. We all believe we're above average drivers, right? And we all believe we're just above average in general. And the reality is we're all pretty much average. None of us can control as much as we think we can, but it's not going to stop us from trying to do something, right? And so when the market goes down, humans want to do something,
Mhm.
right? And frankly, the worst time to do something is when the market's down because you are now locking in losses. When the market goes down, if you haven't sold anything, you actually haven't lost any money,
Yeah.
right? You've lost some value, but you haven't lost any shares of Apple, right? You still have the same number of shares of Apple, they're just worth less.
Mhm.
And if you don't need the money right now, that doesn't matter. But the way that people view their portfolios, they say, oh, I'm down $100,000. I should sell everything and go to cash.
Mhm.
It's like, great. At that one time, when you sell everything and go to cash, you actually just locked in a $100,000 loss that you didn't have the day before,
Yes.
right? And so that's where, I look at passive investing and like on paper, it sounds great, but it fails when it meets human behavior. And so with active risk management, we do something,
Yeah.
right? So when you call us something like, hey, look, the market's down 10%, what are you doing? I can say, well, here's what we're doing. Is it always right? No. Sometimes does it work? Yes. Sometimes do we look like geniuses because we get really great returns? Yes. Right. But like we're doing something, and
Mhm.
that doing something within a strategy, within guardrails and using data, that helps humans get through the downturns in markets.
Right. So are they when they're reaching out to you, are they asking like, "What are you guys doing?" Do you take it over is there options for you to take over for them and help them, you know, do something? Or is it more along the lines of you just kinda giving them an idea of what you guys are doing and they kind of take action themselves? Or is it both?
Yeah, so the way we work at Fireweed Capital is we are fiduciaries, which means that we work on behalf of our clients, basically in our client's best interest. And we're also discretionary money managers. What that means is basically when clients come to us, they move their assets into our custodian, and then they give us the authority to basically trade on their assets for them. And so, they're not calling us up and saying, "Hey, should I, buy this or sell this?" Essentially, our investment team really handles the entire portfolio allocation, portfolio trading, all the strategies, and all that, right? So, yeah,
Mhm.
when the market's down, they're calling us up and saying, "Hey, what are you doing?" And it's like, "Well, here's what the portfolio is doing. Here's what our strategies are doing," right? And then outside of what we're doing for you, like the question then becomes, okay, well, what are you doing for
Yeah.
right? Do you still have a good emergency fund set up? Are you still feeling secure in your job? It's the other stuff outside of the portfolio that we deal with then at that point.
Okay.
Because that's really where, if you want to take action as a client, that's kind of your best bet is to take action outside of your portfolio at that point.
Mhm. Right, right. Well, another, area that advisors still, default to, is diversification as the ultimate, I would say, safety net, right? So why do you believe most diversified portfolios are actually more fragile than people realize?
Yes, this is a great one. So people love diversification. Now, academically, once you get past about 20 securities in your portfolio, you are basically about as diversified as you can get.
Mm,
Um, and I say academically a lot because a lot of
yeah,
what we do is academically based. I've obviously got a doctorate, so I've done a lot of school, right? I read research papers for fun. I'm not the average human, I get
yeah.
that. But yeah, I try to academically ground everything that I have as much as I can because that helps me understand kind of what is likely to be true.
Mm,
So from an academic perspective, right? Diversification is a thing. But once again, I can show you academic papers that say you should buy the market to be diversified. And then I can show you the makeup of indices,
mm,
right? If you've been looking at the S&P 500, if you think you're in 500 companies, fun fact, you are heavily exposed to tech, right? Like massively overexposed to tech. Depending on how NVIDIA is doing, up to like, I think at one point, like 40-ish% of the S&P 500 was in NVIDIA,
mhm.
right?
Yeah,
So like you're not diversified buying the market. You're actually making a highly concentrated bet on the American technology sector.
yeah,
And people don't like to hear that because they think, well, I bought the S&P 500, I bought the market, I'm in the market. No, you're not, right? And people don't really understand how these indices are created and maintained, much less the fact that new companies get added and removed from these indices all the time,
mhm,
right? And that's not based on the strength of the company, right? It's based on meeting the requirements to be in the index,
yeah,
right? And so that's where we run into all these sorts of problems where diversification, as it's talked about academically, makes sense. But when you go to implement the strategy using the available, tickers that are out there, you actually get something much different than what you think you're buying,
mm,
right? And so as long as you're going to be concentrated rather than diversified, let's be cognizant about why we're being concentrated and take a bet on that concentration,
mhm.
right? Like, look, if you really do believe that NVIDIA is the next big thing, like, great. Yes, the S&P 500 is going to do a pretty good job of overexposure to NVIDIA,
Yes.
overexposure to tech, and some diversification throughout the rest of the market. But understand what you're buying,
Mhm.
right? And so when I look at people that use their portfolios to make money, which not everyone does, but some people want their portfolio to double, triple, quadruple in a short period of time. The only way to do that is with concentrated bets,
Mm,
right? And now that's very different than investing for retirement, right? But again, like it's all about what do you actually have in your portfolio, right? And are you actually being more concentrated than you think? And I think most people are.
yeah. So is there a lot of short-term investors coming to you guys just because, being concentrated, of course, you want it to be there's a lot of short term as well, right? Of course, there's long term, but at the same time, S&P 500 is changing all the time, right? So, are you guys more focused on the short term versus long term, or is it a little bit of both?
Yeah. So our clients come to us for the long term,
Okay.
right? They are looking at us for investing for retirement or
Mhm.
investing for a goal far off. The usual number that I say, and a lot of financial advisors will say this as well, is if you don't need the money for about 3 to 5 years, investing it in the market is a good option,
Yeah.
right? But that is truly your time horizon, right? If you're going to give me money and you need it back in 6 months, it is not going in the stock.
Right.
It is way too volatile, right? So you invest that money for 3 to 5 years, probably longer.
Mhm.
And when we then take that money and we are managing that money, we run multiple different strategies. And so some strategies are reacting on a short term, right? Potentially on a day-to-day basis, taking positions. Other strategies are reacting over a macroeconomic cycle, right?
Mm,
So they may not change positions for a quarter, 2 quarters, right? And kind of all through the gamut in there, right?
right.
So we don't just run one strategy, right? There's multiple strategies that are being run on the money that we manage. Essentially because some strategies do well in certain market conditions and some strategies do well in others. And again, this is where we think about diversification,
Mm,
right? That we're going to be diversified in our trading strategies. So we're not overexposed to any one particular market scenario.
mm. Are those strategies being run driven by AI at all for you guys?
No, so they're not AI driven strategies. No, it's obviously I don't talk about the individual implementation
Of
strategies,
course,
right?
of
Because
course,
that's,
of course.
yeah, if you want to become a client, you can see the tickers we use.
Yeah.
But yeah, in terms of like the data points and stuff like that, right? Like, yeah, no, we get multiple different data points to generate signal to
Mm.
take positions inside those strategies.
Got it. Got it. Do you see AI and data driven or, AI investing actually creating an edge in the future?
It's a great question. I actually gave a talk on this
Yeah.
at the Financial Planning Association's annual conference. Oh God, what was it? 4 or 5 months ago now,
Yeah.
November.
Yeah.
Yeah, I think it was November. Um, and basically, at that time, the talk I gave was you should be thinking about AI as a way to build portfolios, right? So you can optimize a portfolio very quickly. Say, hey, give me these 5 securities, give me a portfolio with the highest Sharpe ratio, right, or the lowest volatility, or the lowest, max drawdown, right? And that's kind of what I was thinking about AI at the time was, you can combine these ingredients together to create the best portfolio along a certain dimension for a client.
Mm.
Now, fast forward to where we are now in April, and AI has changed dramatically.
Yeah.
The difficulty with using AI for trading strategies is not using AI, but the implementation of the trading strategy. So, for instance, there was an academic paper that was published on basically factor analysis and using factors as a way to generate persistent alpha. And for those of you who don't know what that means, it's basically looking at certain data points in the market, you can consistently outperform for the amount of risk you take, right?
Mm.
That's a pretty cool scenario. And
Yeah.
so I basically took the paper, fed it into Anthropic's Claude, and Claude and I worked on ripping apart the paper for about a week and rebuilding what they had done from the ground up.
Wow.
And we found that about 70% of the alpha actually could be reproduced the way that they said, which is not bad for an academic paper. Like being able to reproduce an academic paper in itself is pretty good.
Hmm.
And so I said, okay, well, great. Like we've got a trading strategy here that actually works. It outperforms, right? And I said, okay, let's implement it. And we went through, again, AI and I went through the market and tried to find a set of tickers that captured the factors correctly, allowed us to trade on the strategy and maintain the alpha, even when we were accounting for transaction fees.
Hmm.
And what I found in this particular case is we could not replicate the academic strategy using what's out there in the market that I had access to at the fees that I would be paying in a way that makes it profitable.
Wow.
Yeah. So the problem is not using AI to trade, it's finding something to trade that works with the strategy that AI has built.
Hmm. Yeah. No, and that's exactly it. I think, is that people want to think that this is going to give them all the answers, right? But if everybody's doing it, it's always going to shift. It's not going to make it so everybody's going to be able to win because it's just not going to happen. The market's going to shift because of what's happening now, right? And so I think that a lot of people are utilizing AI because they think this is going to be, what's going to set them over the top. And maybe some, early adopters, maybe, it might happen. But like you said, if you weren't able to find it, and you've been doing this for as long as you have, not to say somebody can't, but it's going to be difficult, right?
Exactly. Yeah. And again, the difference between using AI for trading to develop a trading strategy and then actually implementing that strategy using the available, stock tickers that are out there and available financial instruments, those are two very different things.
Right.
I actually just talked about, kind of what's difficult about active management. And quite frankly, the difficulty with active management is finding a way to replicate your strategy in the market.
Mm.
Because that's
Yeah.
where a lot of alpha disappears is all of a sudden your strategy, you can't find tickers to trade that actually replicate your strategy,
Hmm.
right? And then all of a sudden, well, that's not a strategy you can trade at all.
Yeah, exactly. Yeah. I mean, even though AI is the buzzword now, and everybody's utilizing it, it's been out there for a long time, right? So, and just in the different aspects of it, right? So, of course, in the last, what you said from November to now, it's changed drastically, but there's been tools out there that people have been utilizing to try to time the market and get the best, returns. But again, it's going to be an upward battle, for a uphill battle for quite some time, I'm sure.
Exactly.
Yeah, no, for sure. So I guess I did want to ask you, for founders or high earners who have built significant income but haven't built a strategy yet, what should they prioritize first? Because I think that even when people come into like liquidity events, what would be something that you feel like they should prioritize first?
Yes. Let's talk about liquidity events in particular, because
Yeah.
I think this is something that, founders have kind of a sudden wealth thing that happens.
Hmm.
And for a lot of high income earners as well, your compensation may be tied to stocks or an annual bonus, and those can be sizable.
Hmm.
So if you are the type of person to likely have a sudden money event in the future, start planning now. The worst time to start planning for a sudden money event is when you open up a bank account and you've got a bunch of money in there, right? So really, quite frankly, find somebody who's gone through this before. That can be a financial advisor who's dealt with this before. It could even just be a mentor or another entrepreneur who's gone through this before, and just picking their brain, right? Just get a plan, get an idea of kind of what happens with this sudden money. And then from there, it really is a question of, once you have this money, what do you want to do with it? Right? One of the fundamental tenets of my financial advising practice is money exists to help you live the life that you want to live. So what is the life that you want to live? And that's something to think about, especially if you're sitting on the potential for a million or multi-million dollar payout. Because frankly, one of the fastest ways to lose your sunted money is you go out and you buy a yacht. When you didn't need to buy a yacht, all you needed was, a boat, right?
Nice.
And it gets really easy the more money you have to just be like, well, there's four options. I'll just take them all because it doesn't really matter,
Hmm.
right? And when you didn't have the money, it was like, well, there's four options. I should figure out which one I really want,
Yeah.
right? And that kind of lifestyle creep is what ends up happening. And so you want to start guarding against that.
Hmm.
When it comes to an investment strategy, then, again, you got to look at, what do you want the money to do for you? Is this, you got $1 million and your goal is 10 million? Well, then you're not there. You got money, but you're not at your final goal yet,
Hmm.
right? And so your investment strategy should still be focused around growing that wealth, right? Because you're not there.
Hmm.
Um, but really, kind of the basics. If you're a founder who's never had the money before, now you come into sudden money, well, like, okay, basics, you got to take care of your emergency fund. You probably got to pay off whatever debt you have, right? You want to go find a house that's reasonable, maybe buy the house in cash, depending on your risk tolerance. But really, when it comes to investing, one of the things that I talk to folks about is, you want to take measured risks in parts of your life, and you want to be cognizant of the risks you are taking. So as a founder, if you are likely to sit there and say, I've sold the company, I'm going to turn right back around next month, I got another idea. Like, that's awesome. I played the startup game for a long time in tech.
Yeah.
I loved it. I've had
Yeah.
companies that have gone bankrupt. I've had companies that have been like, hey, guess what? We can't pay you this week, but next week, right? I took a lot of risk with my income,
Hmm.
and my portfolio wasn't necessarily risky,
Right.
because I knew if stuff hit the fan, I'd have to live on some pot of money,
Hmm.
right? And so if you're that founder that is now sitting on millions and you're going to turn around and start up another company, awesome.
Yeah.
Do not risk that portfolio, because that's the money you're going to have to fall back on when the next venture hits a rough patch, right? And you don't want to have that money all of a sudden disappear as well, because you're being aggressive with your money and aggressive with your venture. And like, that's a recipe for ending up homeless.
Right. Yeah, exactly. I feel like you see it a lot, whether it's, professional athletes or again, somebody who just falls into a bunch of money comes their way. Again, a liquidity event. It's the fact that it's very easy to just go out and start spending it, and then all of a sudden you realize, man, that money was just cut in half and I've only had it for, a year or whatever, but it's very easy to do. But if you don't have that fallback, like you mentioned, then it's going to be very easily, you're going to be, like you said, it's the worst time to do it after you receive it. You should have a strategy already in place to the best of your ability, because it's good to have something that is going to be somewhat secure. Nothing is perfect, but something semi secure that you can fall back on versus, just being like, oh, I'll be fine. I'll figure this out. But there's so many people out there like yourself who can help a lot of the listeners, who might come into something like this, or maybe even if it's not a bunch of wealth, but it's something that you're working towards getting to and you have goals. Make sure that anyone who's listening, you guys are reaching out to Dr. Link and his team, because they've done some amazing things. And, Dr. Link, I do really appreciate you joining today. It's been an amazing conversation. But for any of the listeners who want to go deeper, where's the best place for them to connect with you, follow your insights, and learn more about the work you're doing with Fireweed Capital?
Yeah. So you can find us online, fireweedcapital.com. You can also email me directly, Adam at Fireweed Capital, Adam at fireweedcapital.com. And yeah, honestly, when I think about the folks that I love working with, I love working with families. I love working with folks who have a dream and a passion, they want to pursue it. Like I said, kind of initially, once you hit that $1 million mark, you kind of look at your life and you go, what do I want to do? Well, for me, I love helping folks get their financial plan in order and striving towards, their own $1 million mark. Like honestly, that energizes me when I start to talk to people and they're like, yeah, I'm gonna like do this and this, and that'll get my first million, and this will be the next million. It's like awesome. I want to come alongside you, and I want to help you get that, man. Like
Yeah.
that is fun stuff.
Right.
So if you're that type of person and you're listening, yeah, reach out. Let's talk through how we get that million or that next million.
Yeah, it almost triggers that fire again for you, right? When you're helping others get to that point.
Exactly.
Yes.
Exactly.
I love it, Dr. Link. Well, thank you again for joining today. I really do appreciate you joining me and spending time with myself and the listeners.
Thank you so much.